China's currency has been sliding for years, and it's not an accident. Since 2022, the Chinese yuan has fallen roughly 10% against the US dollar. On the surface, that may look like a sign of economic weakness, a slowing economy, a struggling financial system. But what if the story is more strategic than it appears? What if this isn't a crisis, but a calculated move? To understand what's happening, we need to understand how China manages its currency in the first place. Unlike the US dollar, which floats freely based on supply and demand, the yuan operates under what's called a managed float system. That means China's central bank, the People's Bank of China, doesn't allow the currency to move freely. Instead, it sets a daily midpoint and allows the yuan to trade within a narrow band around it. This gives policymakers control, and control is the key word here, because when growth slows, when exports weaken, when foreign investment pulls back, currency policy becomes one of the most powerful levers left. And right now, China needs levers. After decades of explosive expansion, the Chinese economy is facing structural challenges. Real estate, once the backbone of growth, is struggling. Consumer confidence has weakened. Youth unemployment has risen. Global demand has softened. Factories still produce, but buyers are more cautious. And when demand slows, competitiveness becomes everything. This is where a weaker currency comes in. When the yuan falls against the dollar, Chinese goods become cheaper for foreign buyers. A product priced at 100 yuan suddenly costs fewer dollars. That makes Chinese exports more attractive globally. In simple terms, currency weakness acts like a discount sticker on everything China sells to the world. And in an economy still heavily reliant on manufacturing and exports, that matters. But here's where it gets more complex. A weaker currency isn't free. It comes with consequences. When the yuan weakens, imports become more expensive. Energy, commodities, advanced technology, all cost more in yuan terms. That raises input costs for businesses and can pressure inflation. It also increases the risk of capital outflows. If investors believe the yuan will continue falling, they move money out of China to avoid losses. Wealthy individuals and corporations convert yuan into dollars. That creates further downward pressure on the currency. So China has to walk a tightrope, let the yuan weaken enough to support exports. But not so much that confidence collapses. This balancing act isn't new. In 2015, China surprised global markets with a sudden yuan devaluation. The move sparked fears of a currency war and triggered turbulence in global stock markets. Capital outflows surged. Beijing had to burn through foreign reserves to stabilize the currency. They learned from that episode. Today, the weakening is slower, more controlled, gradual. Instead of shock therapy, this is strategic drift. And the timing matters. The U.S. Federal Reserve raised interest rates aggressively after 2022 to fight inflation. Higher U.S. rates strengthen the dollar. A stronger dollar automatically weakens other currencies, including the yuan. China could fight that by raising its own interest rates. But that would slow domestic growth even more. Instead, policymakers chose the opposite approach. They cut rates to stimulate their economy, which naturally weakens the currency. In other words, the yuan slide isn't simply imposed by markets, it reflects policy priorities. Growth over currency strength, stability over prestige. But there's also geopolitics in the background. The US and China remain locked in strategic competition, from trade to technology to military influence. Tariffs remain in place on many goods. Export controls restrict access to advanced semiconductors. A weaker yuan offsets some of those pressures. If tariffs make Chinese goods more expensive, currency weakness can partially neutralize that cost. It becomes a silent countermeasure. Yet there's a global reaction risk. If other countries see China deliberately weakening its currency to gain trade advantage, they may respond. Accusations of currency manipulation could resurface. Trade tensions could intensify. So far, China denies any deliberate devaluation. And technically, they're not aggressively pushing it down. They're allowing market forces more room within limits. This subtlety is important. It's not a crash, it's a glide. And there's another layer most people miss. China has long wanted to internationalize the yuan to reduce reliance on the US dollar in global trade. Initiatives like the Belt and Road projects, bilateral currency swap agreements, and energy trade settlements in yuan all aim to expand its global footprint. But internationalizing a currency requires trust, stability, predictability. A sharply falling currency undermines that goal. So China faces a contradiction. Short-term growth may benefit from weakness. Long-term ambition requires strength. That tension defines today's strategy. Meanwhile, inside China, the government is managing expectations carefully. State banks sometimes intervene by selling dollars to support the yuan when it weakens too quickly. Officials issue verbal reassurances. Capital controls limit how easily money can leave the country. The message is clear. This is controlled. This is intentional. This is manageable. But markets always test control. If economic data worsens, if real estate deteriorates further, or if foreign investors lose confidence, pressure could intensify beyond policymakers' comfort zone. And that's the real risk. Currency policy works best when confidence remains intact. Once confidence breaks, stabilization becomes expensive. China still holds over $3 trillion in foreign exchange reserves, a massive buffer. That gives Beijing significant firepower to defend the yuan if necessary. But reserves are not infinite. And deploying them aggressively signals vulnerability. So instead, China prefers subtle tools, guiding expectations, managing liquidity, adjusting daily fixings, allowing controlled weakness, all while publicly emphasizing stability. From a global perspective, the effects ripple outward. A weaker yuan pressures other Asian currencies to weaken as well to remain competitive. That can trigger regional currency adjustments. Emerging markets with dollar-denominated debt may feel strain if the dollar strengthens broadly. Currency shifts don't stay local. They echo. For the United States, a weaker yuan makes Chinese goods cheaper, which can help reduce inflation in America. But it also widens the trade imbalance, complicating political narratives. For Europe, it affects export competition. For commodity producers, it shifts demand dynamics. This is why exchange rates are never just numbers. They are signals, strategies, power tools. And when growth slows, currency policy becomes one of the few remaining levers governments can pull without passing new laws or launching major fiscal programs. China's economic model is evolving. The old growth engine, real estate construction, infrastructure build-outs, and export booms, is no longer as reliable. Demographics are shifting. The population is aging. Debt levels are high. Stimulus options are narrower than before, so policymakers lean on what they can control directly. Interest rates, liquidity, currency bans. This isn't a desperate move, it's pragmatic, but pragmatism carries trade-offs. Long-term capital inflows depend on investor trust. If global funds perceive sustained depreciation risk, they demand higher returns or reduce exposure. That can raise borrowing costs for Chinese firms abroad. It can slow foreign direct investment, and it can limit financial market development ambitions. So the key question becomes, is this a temporary strategy to navigate slowdown, or the beginning of a longer structural shift toward a weaker yuan era? If growth rebounds strongly, the yuan could stabilize or even strengthen. If structural challenges persist, gradual depreciation may continue. And then there's the dollar factor. As long as the US dollar remains strong globally, upward pressure on it automatically pushes others down. If US rates eventually fall and the dollar weakens, some pressure on the yuan would ease without China changing policy at all. Currency dynamics are relative. No currency moves in isolation. The deeper story here is about power. For decades, economic strength gave China leverage. Massive trade surpluses built reserves. Rapid growth attracted investment. A stable currency reinforced credibility. Now, as growth moderates, policymakers must manage perception carefully. Too strong a currency hurts exports. Too weak a currency hurts confidence. The middle path is narrow. So when you see headlines saying China's yuan is falling, understand that this is not chaos, it's calibration. A deliberate adjustment in a complex economic machine. But calibration only works as long as underlying fundamentals don't deteriorate sharply. If domestic demand remains weak, if property markets remain unstable, if global tensions escalate, then currency management becomes harder. For now, the strategy appears measured. China allows weakness, but not panic. Supports exports but avoids shock. Maintains reserves but avoids dramatic intervention. It's a slow-motion policy, not a headline-grabbing devaluation. And that may be precisely the point. Because in geopolitics and economics alike, subtle moves often carry more power than loud ones. The world is watching China's currency closely, not because a 10% move changes everything overnight, but because it signals how Beijing views its economic future. Growth first, stability second, prestige later. Whether this strategy succeeds depends on more than exchange rates. It depends on whether China can rebalance its economy, restore confidence, and sustain productivity growth in a shifting global order. The yuan slide is not the story. It's the symptom. The real story is how China navigates the next decade of slower, more complex growth, and how currency policy becomes a tool in that transition. Because when growth slows and options narrow, the value of money itself becomes a strategic weapon. And China knows exactly how to use it.